So let's talk about how we've integrated that into our system to upgrade W&A with the available technologies. Well, as you know, we do three things it's a hedgehog philosophy. We do three things at W&A. We do financial planning, we do investment management, and then we do a high degree of communications. So let's talk a little bit about the old way of doing financial planning. So many of you have been into this room, right? This is our conference room. Many of you have talked to this guy. This is Tim, taking some notes. And then we used to go back, and these are spreadsheets that Carol Lee at some point built by hand that we used to predict out your future in straight line. And then you'd get this playbook, which we've used that color scheme for years. You'd get your blue and green playbook. And that was financial planning the old way. And by the way, if we were in the meeting and you were like, you know what, I think I'm going to retire 2 years too early, it would screw up all of our spreadsheets, and we'd have to have another meeting. Now, we've integrated technology such that the financial plans can really happen in real time, on the fly, be dynamic in the presence of an advisor. And so here is Carol Lee, and she's working with John and Jane Doe, everybody's favorite client. And they're talking about their needs and their wants and their wishes. And so Carol Lee is working some magic and creating cash flows on the fly. She's talking about asset allocation and what's going to create the highest probability of success. She's running trials, thousands and thousands of trials, and then ultimately coming back and saying, well, our recommendations are status quo. You've got an 81% chance of all your hopes and dreams coming true. If you will do the Roth savings that I tell you to do, then your odds of success hop up to 85%. So what's changed is the ability for all of that financial planning magic to happen real time in a continuous conversation, which takes a lot less time for Carol Lee away from clients and increases the effectiveness, the robustness, and the probability that our financial plans will be successful. Now, here's communications the old way. Here's Tripp. He's on the phone talking to you. We send out quarterly newsletters. You get statements from your custodian, either Schwab or Fidelity. Here is my favorite picture, but here is Friday email, right? That was Reagan gazing, if you remember that one. It was a good one, it's classic. And then, of course, you would get your green book delivered, blue and green book delivered in our conference room. Now, the new way for us to communicate, here's Kathy. You can still talk to us anytime. You can come over, hang out in the office. We got clean restrooms. And now we're utilizing online tools basically so you can stay connected with W&A 24/7. So we have the ability to pull all of your financial information together, all your assets, liabilities, your insurance information, and have it on a dashboard you can access at any time. We've got the ability for you to manipulate, for home gamers, your financial plan to play with your own scenarios and see what will happen. We have a virtual vault where all of your documents that you want to store securely and share only with W&A can go and be secured. And we're starting, you haven't seen this yet, a new communications platform that will allow us to tailor information specific to you. So many of you responded, by the way, thank you for responding to the surveys we sent out. Many of you responded and said, God, I wish I knew more about Social Security or Medicare or healthcare or this, that, or the other. We can now push relevant content to you specifically, in addition to that we generate ourselves, be it our videos or our weekly emails. So look forward to that. On the investment management side, we talked about the old way, which was 100% our macro musings, active managers across value, growth, and special situations. To demonstrate just how robust the new way is, I am going to ask the Deputy CIO of Doubleline Capital Management, Jeff Sherman, to come to the stage and discuss the specifics of our portfolio holding in the enhanced Schiller CAPE product. Now, while he's coming to the stage, if you haven't looked at his bio, you should, okay? Because it says things like he was a statistics and mathematics instructor at the University of the Pacific and Florida State. He taught quantitative methods for level 1 candidates of the CFA. He has a BS in applied mathematics and an MS in financial engineering, which means he may be a robot. So, Jeff.
Thanks, David. I will not confirm nor deny the rumor of that either. So I think I think it's very unique how we're thinking about it, because you look at the cocktail that we see here of active and passive. And it's essentially what we've done to try to invest in the US large cap space. And if you look at the asset allocation he was proposing, he was talking about markets which are inefficient, which are where people can add value. And when you have a highly covered sector of the market, such as large cap equity, perhaps maybe it is saturated. Too many eyes are looking at it, and therefore it becomes more challenging to be a stock picker. And one of the slides I really like the best is that it's not that indexing wins in every situation, right? There still are talented investment professionals, but there's a lot of people that aren't really adding a lot of value. And you should not pay them for that, right? That's why Vanguard has been so successful of collecting something like $250 billion last year. I'll say it again, $250 billion went into just indexing at one single shop, okay? So there is value in this. So at the end of the day, we're active managers. I believe in inefficient markets. If I didn't do so, I wouldn't be here today. We have a staff that runs $102 billion today. And because of some of the automation, we actually do it with less than 200 employees, right? We do that because we're very efficient in what we're trying to do in our tasks. So what I'll show you today is a structure of a portfolio that blends two things together. And it's a very complicated structure when you look at it. There's arrows flowing all around, but it's very simple. What we're doing is we're accessing the equity market through a very systematic strategy. And it's not doing the factor analysis that David was mentioning. It's a complement to that, right? So there is value in that. As a quantitative person, I believe in the factor investing, but I believe it should be low cost, and over time, right, it should deliver some excess return. However, what we did, and this is back in the summer of 2013, a gentleman by the name of Professor Robert Shiller, has anybody heard of him? He happened to win a Nobel Prize after we partnered with him. We'll take credit for that. But what you'll see is that he came in our office and said, I've been working with an investment bank to try to identify ways to be a better value investor over time. And those of you that may be aware of some of his work, what he studies a lot is behavioral finance. And so what we find through systematic investing is that you can exploit the human mind. Not actually getting into the mind and trying to deduce psychological behavior, but preventing yourself from actually behaving psychologically, from the panics, from the depression you get from looking at the market every day. That's my job. I'm actually 22 years old. I have all this gray hair because I look at the market all the time, right? And so what you find is that if you can prevent yourself from being irrational, that's where I see the guys on the phone like Trepp, but I see David talking about, we're talking you into sticking with your plan. That's what systematic investing does. Now, it does cost something to do it, but what we're gonna do is we're gonna access it through some funky stuff. We're investment managers, what we do. But what we end up doing is we can create a more tax-efficient structure. Who here loves taxes? Why not? Right? I live in California. I probably pay the most of all of you on a percentage basis, right? So we're looking at ways to mitigate that. So what we ended up doing is creating a structure where we can access these returns by getting equity market returns, but doing them in a format. It's called a swap. It sounds funky. It's not super dangerous, okay? People who screw things up give investment professionals a bad name. But we do that for a tax efficiency. And what that means is that we can actually go out there and access the equity market through this exposure and then run a lower risk type of bond portfolio underneath it. And what that does is it gives you two unique sources of return. We get this value added return from a systematic process where, as an investment manager, I don't do anything. That's why I can come here to Memphis today. The process runs itself, right? But what we are gonna do is we're gonna focus on this bottom right-hand side and do what Doubleline does best. And it's a little braggadocio, I guess, because I run the asset allocation team. So I think we're pretty decent at running fixed income, okay? But what we're gonna do is we're gonna take calculated risks. We're gonna take very low risk in the bond portfolio. We're gonna try to outperform cash. We're not gonna swing for fences. We're gonna try to do is just generate a little incremental return to cover the execution costs of the other side of the strategy. And so here's a funky chart that no one cares about, but I'm gonna explain what it shows. And what it shows here is that over time, valuation matters. Who would have thunk it? When stuff is expensive, right, your value premium, right? When stuff is expensive, right, it tends to have a below average return. And when it's cheap, it tends to have an above average return. Now, why would that be? Well, because you don't like it when it's cheap. It's cheap because it's been going down. You think that you have the worst investment advisor or the worst investment manager because he's buying something that's down. But what do you love to buy? The thing that keeps going up every single day that's super expensive. So Professor Shiller's work, and again, if you talk to Professor Schiller, a humble man, and he'll tell you he didn't invent this. It's great, you can get a PhD, you can get a Nobel Prize for not even inventing something. Sign me up. I'll take the million Swedish krona. But that said, what you find here is that the valuation matters. And so all he did was say, look, the market is too short-sighted. We're society, and this was in 1988, by the way. This is before ADHD was actually popular, right? We are too short-sighted on how we think about valuation. And if one extends back the period, again, the research that David is explaining to you, if one actually looks over longer time horizons, you have a better chance of kind of predicting the return. Now, there's a lot of math behind it and all that stuff, but it's not perfect. So if you notice the relationship, there's a downward sloping line. The horizontal axis says, what's the valuation ratio? And then the vertical axis says, what is the subsequent returns? Okay? And if I didn't draw that line in there, it's called a regression line. But if I didn't draw that line in there, you would say, it doesn't really look like there's much of a relationship. So I help guide you. I'm a behavioralist, right? I'm showing you that, look at the downward sloping line. And this is not the market, by the way, which was the seminal research by Professor Schiller. But this is actually the sector of the U.S. large cap space as measured by the S&P. So we show here on the left-hand side is this relationship that it held at the market level actually holds for any single portfolio you can put together. Now, a single stock doesn't work because you're driven by the noise in the company. What you see here is that industrials or utilities, and I can show you this for the other 8 sectors of the market and bore you to death, but the idea here is that there seems to be some predictability in it. And therefore, we should be able to try to extract that over time. And so another wall of letters up there and lots of words. But what we're saying here is that if you can follow a process that uses this metric, right, on a monthly basis to dictate how you should do asset allocation. Okay? And it's very simple. This is the nice thing about Professor Schiller. If you ever get a chance to see him speak or talk to him, he's a very simple man. Very complex when it comes to econometrics and mathematics, but he's a very down-to-earth person. So he wanted to create a process that says, how can we use this metric to invest? Okay? So what happens is you take the 10 sectors of the market and you look at these ratios. Okay? Now there's one little thing you got to think about. If you use a ratio and you're comparing technology, which trades at a high multiple, right? The uncertainty of the cash flow, right? The future growth. And you compare it to something like utilities, which was your word boring, right? Lame, yeah, stupid, income, right? People hate bonds, let's buy that stuff, right? What you find there is that it's always going to trade, or historically is traded, always is a dangerous word in finance, but it's historically traded at a significantly lower multiple. So you can't compare them outright. So what you do is you take each sector and compare it to its own average. How does it trade within the range? Does it look cheap from a historical perspective? It's exactly how you would think about assessing value. And you take these for each of the 10 sectors and you rank them relative to their own history. Therefore, we can create this ratio that tells me which markets look cheap. So of the 10 sectors, if we rank them, the ones with the lowest ratio will be the cheapest sector of the market. So I told you it's a pretty simple process. It's so simple, it's embarrassing that we can sell it and make money off of it. That said, it makes sense, right? It's how you're entrenched of thinking about valuation. Now, there's one wrinkle when you start to think about value investing. What happens if it's cheap and it's getting cheaper? Oh, the psychological barriers, right? Think about energy in 2015, right? Think about financials in 2009, right? Think about technology in 2001. Right? It's going down for a reason. So what you do is you put one little wrinkle in there of the 5 sectors that you're going to find the cheapest. You throw the one out that's been the worst performer. And there's a lot of academic research behind this. It's called the momentum side. Another thing you show that add value. Right? And if you remove that sector, it can improve the performance over time and reduce the drawdown. Who wouldn't want to increase performance and reduce the drawdown? So you're left with 4 sectors, and as any good academic does, you just equally weight them. So each month, this process is going to buy 4 sectors of the market. It's a U.S. large cap space. It's not going to use Jeff Sherman's forecast of the market, right? It's not going to do anything that Doubleline does. We are going to believe in a process. And what this demonstrated over time is it has outperformed the market, not since we've been live, but if you take it back to the annals of history, back to 1998, where you have good market data, you find that it's outperformed the S&P by about 4% per annum. Per annum. Okay, it's a pretty strong process. Maybe the world's not the same. Maybe we're in a new regime change. Maybe it's only 2% per annum. But in a world that has lower growth, lower rates, perhaps with rates going up and causing inflationary pressure, if you get a couple extra percent a year, it's good for your investment portfolio. So that's exactly what it does. That's the systematic component. All right? So why am I here? Why am I here to explain to you this systematic process? Well, one, it at least allows you to buy the cheapest parts of the market. It allows you to stay invested. It makes sure you may not have to make that phone call in to talk you off the ledge, right? I always like to say, when we lock up money for clients in hedge fund strategies and long-term strategies, we're protecting you from yourself. We have very sophisticated investors, and guess what? In 2008, do you think they all were just calm and just running through, just dancing in the halls and saying, "Oh, you guys are doing a great job"? They were scared to death. You protect yourself from yourself. So that's where the systematic can help. What's the market look like today? Well, we went through a lot of the review of performance data, and working in the fixed income market, go up there, there's an old saying we have. There's no bad bonds, there's just bad prices. Right? There's no bad bonds, there's bad prices. What does that mean? Well, think about it. What that means is that if you get compensated for the risk you're taking, it's a risk worth taking. So let's talk about what these valuation metrics look like today. Okay? And notice things had changed around November of 2016 in terms of valuation. And the ratio on the side, all it says is how does this sector trade relative to its 20-year history? What's the valuation today look like to that? Does something look a little awry today? Does something look a little overpriced? It's the narrative. It's the financials, right? But notice what was grossly overvalued for the last couple of years. Things that were proxies for income. Yield, right? Yield search-based investing. Going into real estate, going into the brown line, utilities were some of the most overvalued parts of the market. And by avoiding some of these sectors, especially when you had the second half of last year, right, when things come back down to earth, which they tend to do in sectors over time, sometimes it takes time, right, you avoid the things that have the most drawdown. In market crashes and collapses, it's the most overvalued, which drives you down. So remember, these are sectors investing. We're not taking any view on stocks. The process doesn't do that. But this is what's pretty amazing. Look what's cheap, right? Technology, healthcare, consumers, the discretionary staples, and industrials. Who wants industrials? We don't make anything anymore, right? But that's the narrative. That's the behavioral side. It looks cheap. And guess what? Industrials have been just as strong a performer as the broad-based market. In fact, over the last 3 years, they've outperformed the market. So again, what you need to look at is what the fundamentals are telling you. Look at what else has been loved recently. The reflation trade, right? The idea that energy prices have to go up. In my career, it's one of the few areas I've seen people throw good money after bad throughout the entire crisis of it. People never gave up on energy. Maybe that's just the American way, right? Maybe all the guys in Texas that we hear about buying oil every single day were the ones driving it. But again, the process pulled us into energy and pulled us out when it got rich again, right? It's systematically protecting you from overvaluation, okay? So I talked about we mix it with the bond portfolio. That's what we do. Again, what you find here is you get a portfolio that yields in a low kind of 2% range, 2.5 range. Better than investing in the interest rate sensitive parts of the world. It's got a lot of stuff in it. We got a lot of investment people. Of the 200 approximately 200 employees, 130 are investment professionals. We're very top heavy on the investment side because we focus day to day grinding through markets to manage the risk. So if this can outperform cash, what does cash yield today? You showed it on your chart. Well, the Fed funds rate yields 63 basis points or 0.63%. Who's getting that on their bank account today? Right? No one, right? So you're getting very low returns. So we're outperforming cash right now, or we had the potential to do so with the yield by about 2%. And the last thing I want to address here is that if you think about it, people say, well, interest rates go up. David said it. If interest rates go up, that's bad for a bond portfolio. Why would I want to do this when we have Trumponomics? Well, I'll tell you, since the 10-year bottomed in July of last year, our bond portfolio has made about 1.5%. In a rising interest rate environment where rates have risen over 1% over a short period of time. So if you do it right, and you look at the way that David has set up the portfolio with all the investment committee and all the investment professionals that focus on it, right, it's the same type of ideas that we're doing here. We're not just blindly buying indices in the bond market. And here's the thing about the bond market. The index is the worst investment you can buy. So tell Vanguard I said it. Okay, I don't care, because I'm right. Here's why. They are market cap weighted just like the S&P 500. So what does that mean? As you borrow, as an institution, you borrow more and more money, you get a bigger and bigger piece of the index. That's very intuitive. The more you go in debt, the more I should lend you money. That sounds like throwing good money after bad. So the bond market has a better chance of outperforming, or good managers have a better chance of outperforming there, and that's why you see it. So when you look at the ratios of 3-year numbers, 5-year numbers, and 10-year numbers in the fixed income market, there tend to be 60, 70, 80, 90% of managers outperform. And the top 10 managers have done so really over almost every single trailing period. Okay, so it's a different world where the automation doesn't work as well, right? Because the construction of it, and it takes people assessing the merits of the investment. So what does it look like over time? We've had the fortunate experience of outperforming the market. You can see it's a sector rotation project. This just shows you what drove the performance, what's the contribution from every sector. And if you look at the dates here, this is the 38 months that it's been in inception, it's existed. And what you see here is that every single sector that it's been allocated to at some point in time has added value to the process. It has made you money. Okay? Right? So again, you may not like the process, you might believe in it, but the evidence looks like it's systematic, it's evidence-based type of investing. And over this period, the S&P 500 has done about 36% cumulatively. This index has done 46%. So about 10% outperformance over, a little over 3 years, so about 3% per annum. Right? I'll take that kind of performance. The next thing is, look at what the bond side did. What did the team at Doubleline do by trying to outperform cash? Right? We added another 11%. All these numbers are gross. So the caveat is, there is expenses involved. It's about 100 basis points all in. And what you see here is that just take the 100 basis points away from us each year. Right? Just say that we can't do it. We're the ones responsible for it since we're getting the strategy. That gets you back to about 10%. And what you notice here, your outperformance is about 20% on a cumulative basis. That means you've outperformed by 470 basis points per annum using this process net of fees. Okay? And so what we find in this is that you can blend the two worlds together, which is why I flew from Los Angeles. I like the speech that David's giving. I like exactly what he's telling you to prepare, to plan. It's exactly what we tell our investors. It's just we do it more at an institutional level with a little bit more of an asset base. But anyway, thanks for having me, David. If there's any questions, we'll be around after the talk, too. But I'll let you continue on.
Clearly, you've been a professor. Great job. It's not fair. He's been a professor. It's my goal in the afterlife. All right. So to fully take advantage of the technologies available to us, we're actually launching a brand new product. New service, I should say. And it's called WNAI. Get it? AI. Real proud of that. Investments Online. Here's the difference between this offering and our current core service offering. So on the investment side, it's going to be restricted to passive only. That's a constraint that the machines at Schwab basically put on us. On the WNA Wealth Strategist side, there are no restrictions to our investments. We can go anywhere. Obviously, Doubleline's done a great job for us. Financial planning tools are online, which makes them somewhat limited, although as balances get larger, we'll engage the human factor. On the WNA Core Wealth Strategy side, obviously, it's a very in-depth communicative iterative process. I am very proud to announce that other Prescott has taken on the responsibility of being our service support specialist. So Allison, get up, wave. Now, on the communication side, on the W&A side, obviously for the core offering, you have an advisor that's appointed to you, CPA, CFP, CFA, or whatever we can get to help improve your plan. What differs so much is that because this is basically automated with some assistance from Allison, we can get the minimums down to almost nothing, right? Which is fantastic because so many of you have come to us over the years and said, God, I wish the grandkid or the son or my employee or somebody could access your services, and we've had to say we just monetarily can't. Well, now, thanks to technology, we can. So the minimum's $5,000, the fees are a flat 1%, and as you know, for our core offering, it's $500,000, and we start at 1 1/3 and descend based upon account size. So the interesting thing about going through this process is we had to price it, right? And so that became a thought experiment around what are our services really worth? And so we went back and looked at, again, these functions and said, okay, we do 3 things. We do investment management, we do communications, we do financial planning. What's the difference between a man and machine offering and a machine offering in terms of value? And we relied on studies from Vanguard, Russell, and Morningstar, and a Canadian report to help articulate this. But essentially, let's just talk about the investment activities. Now, in terms of portfolio returns, who knows what the future holds? So one may outperform another, but there's no way to know that. What's knowable is that based upon empirical evidence, portfolio rebalancing systematically, as Jeff kind of mentioned, systematically, ends up adding about 28 basis points, almost 1/3% a year. Now, we can do that on the wealth strategy side, and we can also do that on the AI side. Now, the cheapest implementation costs you can get, the robo-advisor platforms du jour, are about 35 basis points, so that's value that's sort of added in there just as table stakes. And so the investment activities, probably on both sides, without including investment returns, are worth about 63 basis points. Basically the same. On the financial planning, as you would expect, the human factor really kicks in. And so the estimates are that a working financial planner can add about 73 basis points worth of value through plan construction costs and services. You can do financial planning online. You see those offerings, but it's not very robust, so maybe that adds 10 basis points. Then on the tax management side, we have a lot of conversations. The reasons why we have so many CPAs on staff is saving you money on taxes is the exact same thing as increasing investment returns. So those conversations in terms of where to house assets and how to make tax smart decisions probably adds about 60 basis points a year to the core offering. There are tools that will allow you to do automatic tax harvesting of lost positions in the AI world, but probably that's worth about 25 basis points. So you can see the financial planner as a human starts making a contribution estimated to be about 133 basis points, 1 1/3% a year versus about 35 on the AI side. The value to the relationship, according to the studies, is really the communication, which is what we're doing here tonight. So having the opportunity to have an iterative conversation, especially at market inflection points, trying to talk you off the ledge or talk you into buying in 2009, historically adds about 1.8%. Now, on the AI side, you're exposed to lots of articles on the interweb that tell you what to do, but we all suffer confirmation bias, so we really only seek out those articles that think exactly the way we think, right? Now, the value of a good investment advisor is maybe they turn the coin over. So maybe you get some value reading all that stuff, but not a whole lot. Adding it together, what the studies showed was on the core offering side, the combination of the man with the machines deployed appropriately adds about 3.75% in annualized value. Now that's Vanguard's number, not ours, speaking of Vanguard. On the AI side, we figure that a machine with a little human assistance maybe adds about 1.13% in annualized return. So good news, to the advisors at WNA. We are not yet obsolete. You as human beings add mathematically 2.63% annually in value. So keep it up.